Good day, fellow investors. A few days ago we discussed the key concept when it comes to long-term investing, which is prudence. I have been destroyed in the comments, of course, not of the core value investors, but of all others coming to that video, how I'm losing on this bull market by being prudent, missing massive returns, just buy the Nasdaq and forget about everything else, ETFs, I'm complaining because I'm missing out. But here I really want to emphasize on Buffett's key investing strategy, as here a comment says, there are many hours of Buffett explaining his investment philosophy. The people who discount him are either too young, ignorant, inexperienced, greedy, or... So that is the difference between the boring us and the rest of the world. Of course, it's extremely difficult to be boring and discuss prudence when the market has returned with dividends reinvested 11x over the last 15 years. That's a staggering return. The market is amazing, everything great, so nobody can go wrong and everyone feels a genius now. However, speaking of how to approach investing over your whole life cycle, I want to discuss Warren Buffett's strategy. That's what he has been doing all along, just compounding those dividend yields, the earnings, the growth, the buybacks, all that. But let's just, for example, focus on those dividend yields. Because let's say we have 1 million invested, 5% dividend yield and 5% growth. If we look at our value quadrant, the two safest ideas that we discussed publicly here on YouTube are Amsterdam Commodities, 5.5% yield, Aker, 10% yield, both giving potential 8% growth, 4-5% growth there, better than our example. Of course, if you want even better growth ideas, check my research platform. Now, if we invest $1 million, just 5% dividend yield, and then that dividend grows 5% per year, this is the dividend situation. Of course, first year 50, then 52, 55, up to 77,000 over 10 years. If all else equal, even the investment grows at 5% per year, that goes to 1.62 million over 10 years. Total return, 5% growth, 5% per year, of course, plus the dividend. So when we add the dividend, 5% growth there, we get about 600,000 in dividends. Of course, the distribution there matters, 2.24 million after 10 years for a compounded return of 8.39%. Here you have the dividends, the payouts in thousands per year. And you will say, okay, Sven, 8.49%, that's nothing. Nasdaq, gold, Bitcoin, all give 20-30% per year. 50-70, the Nvidias. Why are you even discussing 8.39%? Well, of course, those dividends are not going to sit on my account and zero. I'm going to invest those in value investment opportunities. If I invest at 5%, of course, the 5% growth per year, then the payouts are growing towards, when you accumulate in year 10, 77 times 9 in this case. Okay, that's already something, but this is perhaps better explained with Warren Buffett's strategy. This is November 2016 Berkshire Hathaway Railroad deal that he bought in 2009. By 2016, Warren Buffett got 22 billion in dividend payments from Burlington Northern Santa Fe. You can see here 4-5 billion. First, value investing. You buy when things are ugly, you wait for the cycle to improve, and then you're getting a 10% dividend yield. He didn't buy here and pay 60 billion to get a 5%. Okay, but that's something we'll leave for other videos. Then, what did he do with that money? He reinvested in value called Apple. That then did a 10x. So if just one dividend is invested, and because you invested in value, because it was a downturn at that moment over the 10 years, let's say it becomes a 10x. That's already something, we deduct the 77, we add the 500,000, 550K to that, and already everything, just from one smart value investment transaction that you had the cash to do that, allows you to change completely your return from 8.39 to 10.4 per year. Again, 10.4, Sven. Well, let me continue on this boring mathematical example. The dividends and all, if you're prudent, if you wait for the right opportunities, and if you look at the fundamentals, compound even faster. Because, yes, everyone is greedy now, but the strategy there can be very different. Because what happens here, all these recessions, overvalued markets and things like that, if you're not focused on fundamentals, you easily fall trap to other things and therefore miss out on the key value investment strategy, and that is if you buy value. If you just reach 7%, not the 5% dividend yield compounded, that gives you another 2% per year. Something gets acquired, this or that happens, like, I don't know, Rubies that's going on now that we discussed here on the channel. And then you are already in the 10 to 15% return. No matter what happens, that's the key. If we look at this, yes, great, 11x. But the same chart also shows you this, 15 years, 2.85% plus what was the yield here? 1.5 maybe. So 4% per year. The key when it comes to compounding, and why I'm pounding so much on this, is to compound no matter what happens to the market. We are not here to predict economies, we are here to invest on fundamentals. And who is predicting economies? Look at this. This is JPM's chart that they have, of course, discontinued because it kills every investor out there, even the smart ones. Average investor 1998-2018, 1.9% yearly return, below inflation. S&P 5.6, which is, I think, normal for stocks in good and bad times. That's something you can expect also for the next 20 years going on from now. And then you go tilting, okay, REITs have enjoyed lower interest rates, gold, things like that, depending on when you start to measure. But if I can give you 5% plus the value bottom, I think we should be able to get here to 10 to 15, perhaps even higher. That higher depends on the market and situations. Let me know in the comments if this is boring enough. If not, next time I'll be even more boring, but that's the key of investing. So if you can grow 10 to 15%, that's actually where the compounding really takes place. That's what Buffett has been doing for 50 years. He has averaged 20% per year, which is staggering because these opportunities come not only once in a decade, but a little bit more often. That's why I'm focused on that 10 to 15%. Hopefully it will be higher, but I'm focused on it from a fundamental perspective so that whatever happens to the market, I do well. It's easy to be a genius after an 11x and a financial asset bubble. This, as all other things, will end. Bad markets end sometimes. Good markets also end. Cannot go on forever. But then also missing out. Nobody said I'm missing out. I'm focusing on those fundamentals. The market did 15%. I did 15% the last 7 years. My P/E ratio is 10 on fundamentals. The markets is 30 on hope. You make your own decisions. We'll keep on pounding on value.